Friends, the first news is from JSW Energy. Yesterday, that is Tuesday, December 9, the firm of famous investor Rajiv Jain, GQG Partners, sold its stake in JSW Energy through a block deal. They offloaded approximately 0.87% to 1% of their stake in the market. A total of 1.52 crore shares was sold. The deal price was rupees 444 per share, which was about a 2% discount to Monday's closing price. Now the question is, why did they sell now? GQG previously held a 1.79% stake, which has now dropped to 0.92%. Analysts are calling this profit booking as the stock had rallied significantly earlier. Looking at JSW Energy's performance, their net profit fell by 17% to 705 crore in quarter 2, mainly due to an increase in expenses. Their debt also increased to approximately 62,000 crore because they are aggressively spending to increase their renewable capacity. However, the silver lining is that the operating margins, the EBITDA, improved to 57.9%, which shows that the business is operationally strong. The next big news is a jackpot for the infrastructure company Dilip Buildcon (DBL). They have secured a massive 5,000 crore contract from NALCO. This contract is for the Pottangi bauxite mines in the Koraput district of Odisha. DBL will work there as the mine developer and operator, the MDO. This contract has two phases. In phase 1, that's the first 3 years, DBL will carry out constructions including building an 18.5-kilometer long conveyor belt that will take the ore directly to the refinery. The value of this phase is 1,750 crore rupees. The actual mining will begin in phase 2, next 22 years. DBL will extract 77 million tons of bauxite from there. The value of this phase is 3,250 crore rupees. Their fixed mining fee is rupees 423 per ton. This is a very large mine. It has a reserve of 111 million tons and can last for the next 32 years. This means a steady income is secured for DBL for the next several decades. Why is this important for investors? Because DBL, which was a road building company, is now entering the mining sector, where cash flow is more stable. This can increase the company's valuation. The third news is from Swiggy. Their IPO came just in November and now they have immediately launched a new QIP to raise another 10,000 crore rupees from the market. The floor price has been set at rupees 390.51, which is very close to their IPO price of rupees 390. Why do they need so much money right now? According to reports, Swiggy has already used or committed 80% of its IPO money. Essentially, this is the quick commerce war. Zomato or Blinkit has just raised 8,500 crore and Zepto is also preparing for an IPO. Swiggy needs money to survive. Where will this 10,000 crore rupees go? The largest portion, that is 4,475 crore, will be used to build dark stores and warehouses to make delivery even faster. About rupees 1,100 crore will be spent on marketing to ensure customers don't forget them, and the remaining money will be spent on technology and cloud infrastructure. The market reacted positively to this news, sending the stock up by 3%. Investors believe that even though the company is running at a loss, having cash liquidity in their pocket will allow them to survive this price war for the long term.